Welcome to the Deep Dive. If you've been keeping an eye on business news, you might have heard about Post Holdings. They're a real heavyweight in consumer packaged goods,
Mhm.
and they've been talking about having an excellent year in fiscal 2024.
That's the term they used, yeah.
So today, we're really going to dig into that. We'll look at their recent performance, their strategy,
hmm
basically pulling back the curtain on what made it so good.
And we're basing this all on their official annual report and, other public materials they've put out. And
Exactly.
our goal today really is to give you the shortcut. We want to unpack those key financial wins from fiscal 24, look closely at the strategic moves driving that growth,
Right.
explore the really diverse business segments they have, and also take a hard look at the challenges and risks they themselves see coming.
It's about helping you get a quick grasp of what it takes to run a big, diversified CPG company in, well, today's market. It's constantly changing.
Absolutely.
Okay, so this excellent year claim, it's a bold statement for a company this size. What exactly, when you look at the numbers, made it so excellent? They mentioned a pretty impressive 14% growth in adjusted EBITDA.
Right. And what's really interesting there is how that 14% adjusted EBITDA growth, and that's basically, their core operational earnings before interest, taxes, depreciation, amortization, a really key health metric, how that directly fueled shareholder value.
Okay.
Shareholders saw a really notable 35% increase in share value over the year.
Wow, 35%.
Yeah. And this isn't just a flash in the pan. It fits into this consistent track record they have of long-term value creation. I mean, their shares have shown a 16% compounded annual growth rate since they spun off back in 2012.
16% compounded.
Yeah, and that's even excluding the benefits from the Bellring brand spinoff. So it signals, not just good operations, but real investor confidence.
That's a serious return. And sounds like they weren't just passive observers of their stock price either. They were actively buying back shares. What was it, 3 million shares for about $301 million?
That's right.
What's the thinking behind buying back shares like that, especially when they do it at an average price, around 12% below their stock price at the end of the fiscal year?
Well, it definitely shows they think their stock is undervalued, doesn't it? When a company buys back its own stock, especially at a discount like that, it's a strong signal of confidence.
Right.
And it's an efficient way to return capital to shareholders, by reducing the number of shares out there.
Yeah.
And if you look bigger picture, their adjusted EBITDA, it's actually grown by about 46% over the last 2 years.
46%, that's huge.
It is. And roughly half of that came from just organic growth, within their existing businesses. The other half, that was from acquisitions.
Ah, okay. So a mix.
A mix, yeah. And their net sales jumped to up $931.7 million, or 13% in fiscal 24 compared to the year before. Operating profit saw a big lift too, up $194.6 million, or 32%.
So these aren't just random numbers. They really point to solid operations and successful expansion.
Precisely. Both disciplined execution and smart strategic moves.
Okay, so those strong financials didn't just materialize out of thin air. This is where it gets, I think, really interesting. Beyond just running the day-to-day well, Post was making some pretty bold strategic moves, acquisitions specifically.
Yeah, they were active.
In fiscal 2024, they made two key acquisitions that really shifted things for them. Can you walk us through those? What was the strategy?
Absolutely. So first, they brought Perfection Pet Foods into the fold. Now, this company makes and packages private label and contract pet food, baked treats,
Okay.
and adding them effectively doubled Post's footprint in the pet food category,
Yeah.
which sits within their post-consumer brands segment. This wasn't just adding a product line. It was a major push into a category known for, high growth and good margins.
A significant expansion in pet food then.
Definitely. And at the same time, they acquired D-Side cereals over in the UK. D-Side produces private label cereals, and that got rolled into their Weetabix segment.
Ah, strengthening Weetabix.
Exactly. But what's really notable about both of these deals is that they brought significant additional manufacturing capacity.
Right. Capacity, that seems key.
It is. It's not just about having more factories. It gives them really crucial opportunities to optimize their whole production network, improve their supply chain resilience, find internal efficiencies. It's quite strategic.
So it's about getting bigger, yes, but also smarter, more efficient, more resilient.
Okay. And beyond buying companies, their approach to managing their debt and liquidity seemed, incredibly opportunistic too.
Mhm.
I mean, buying back and retiring about $69 million of their own senior notes on the open market and doing it at an average discount of, 11.4%. That's pretty sharp maneuvering.
It really is. Capital markets were pretty choppy in fiscal 2024, so moves like that really highlight their agility. They're managing their balance sheet strategically while still pushing for growth. And they also raised debt.
They did. Raised $2.8 billion in long-term debt through several offerings, average yield around 6.3%. But here's the key thing. Most of that was used to refinance existing debt.
Ah, okay. Not just new spending money.
Exactly. They materially extended their maturity ladder, basically pushed out when their big debt payments are due. This adds significant liquidity, gives them more breathing room.
And the result of all that?
Well, a powerful result was their net leverage ratio, that's, their debt relative to their earnings. It actually decreased. Went from 4.8 times at the start of fiscal 24 down to 4.3 times by the end.
So they manage debt smartly, even while acquiring. That positions them pretty well.
It really does. Sets them up well for future capital allocation.
And speaking of that, the board just approved a new plan to buy back up to $500 million more of their common stock starting this August, running for 2 years.
Right. Another signal of confidence and a commitment to returning value to shareholders going forward.
Okay, so these financial strategies, they support what is really a very diverse business. Let's peel back that layer now. What does Post Holdings actually look like on the ground, day to day? You mentioned their business model is decentralized and adaptive. What's the benefit there?
Well, that decentralized structure is actually a key strategic plus for them. It allows for really incredible flexibility. It makes it easier and faster to integrate new acquisitions or execute other complex deals.
Right, less red tape, maybe.
Something like that. And it raises an interesting point. How does having such a wide range of products across so many different channels actually help protect them from market swings?
Good question. So what are the main segments as of September 30, 2024?
Okay, so they have four main reportable segments. First is post-consumer brands. That's mostly North American ready-to-eat cereal, but also pet food now and peanut butter.
Okay. Then there's Weetabix. That's mainly UK focused, right? Cereals, muesli, protein shakes.
Correct. Then you've got food service, which is primarily egg and potato products for restaurants, hospitals, places like that.
And finally, refrigerated retail. That sounds like grocery store stuff. Side dishes, eggs, cheese, sausage products.
Exactly.
It really is like they're in almost every part of the grocery store, plus behind the scenes in commercial kitchens.
They really are. And if you look at where their sales come from, it just underscores that diversity.
Yeah.
Cereal, combining post-consumer brands and Weetabix, made up about 34.8% of their consolidated net sales in fiscal 24.
Almost 35%. Okay.
Eggs and egg products, mainly from food service and refrigerated retail, that was about 26.8%.
Right.
And pet food, from post-consumer brands, that category they've been pushing into contributed 22.2%.
So you can see it's spread out. They're not betting the farm on just one thing.
Precisely. A dip in one area, say cereal, might be offset by strength somewhere else, like eggs or pet food. It builds resilience.
And how do they manage all this operationally? Marketing, distribution?
They use a pretty sophisticated mix. Marketing includes everything from traditional TV to very targeted digital and social media, even co-marketing deals. For distribution, they use third-party carriers mostly, but they also have their own internal fleets for some of the refrigerated retail and food service stuff.
Makes sense for temperature control.
Yeah, and their R&D is constantly working on new ingredients, packaging ideas, new products entirely, and even looking at sustainability improvements.
Is there much seasonality to their business?
That's another interesting point related to their diversity. While some products, eggs and potato, definitely see a bump around big holidays, Thanksgiving, Christmas, Easter overall, their consolidated net sales are actually pretty evenly spread across the 4 quarters of their fiscal year.
So less of those big seasonal swings you might see elsewhere.
Exactly. It smooths things out.
Behind all these numbers and strategies, it's easy to forget there are, over 11,000 people making this happen? Plus all the technology needed. So how does Post manage its people, its human capital? And just as vital today, how do they protect their digital side? Their workforce is global, about 11,480 employees as of last November, mostly US and UK.
Yeah, and what's really telling, I think, is how they seem to weave things like cybersecurity and employee well-being right into their core operations. It's not just about ticking boxes.
So on the people side?
Well, about 18% of their employees are unionized under terms they consider pretty standard and renegotiable. But more broadly, they talk a lot about creating a safe, rewarding, respectful workplace.
Standard goals, but important.
Very important, especially now. Offering clear development paths, career ladders in a tight labor market, That's a strategic advantage for keeping talent.
They also highlight inclusion efforts like an all-in at post-council, training employee resource groups, and encouraging a speak-up culture with a confidential hotline.
Right. All signs of trying to foster engagement. And this focus seems to extend right up to leadership continuity. They managed the retirements of key leaders like Sally Abbott at Weetabix and Mark Delahanty in refrigerated retail smoothly.
Because they had successors ready.
Exactly. Both had apparently groomed strong successors. Colm O'Dwyer and Mike McCoy stepped right in. And we also saw Jeff Zadoks take over as interim CEO during the main CEO's medical leave, which really speaks to their leadership depth.
That's crucial bench strength. Okay, switching to the digital side, cybersecurity, what's their approach?
It looks pretty robust, very much by the book. They use industry-standard security controls, technology, a risk-based approach. They do annual penetration tests.
Where they hire ethical hackers to try and break in.
That's the one. They also maintain and test backup and recovery systems rigorously, have disaster recovery plans for critical systems. Employees get regular training on threats, plus monthly phishing simulations to keep them on their toes.
Seems comprehensive. What about if something happens?
They have detailed incident response plans, reviewed annually, tested with tabletop exercises, and they maintain relationships with outside experts and government agencies. It really shows how vital digital resilience is when your supply chain and IP are so vast.
And who oversees all this?
The audit committee of the board has the overall responsibility. They get quarterly updates directly from the chief information officer, who has like 26 plus years in IT, and the chief information security officer, the CISO, who has over 22 years in IT, 8 specifically in cybersecurity.
So serious experience and board-level attention.
Definitely. A multi-layered approach.
Okay, so a strong year, smart strategy, good systems.
Yeah.
But of course, no business operates in a vacuum, especially one this big and complex. What challenges does Post see ahead? What keeps them up at night? They're pretty open about the risks they face.
They are, and if you connect that back to the bigger picture, it shows that even after a great year, they're very carefully looking at a really complex map of potential hurdles.
So what are some of the big categories? Business and operating risks.
Yeah, under that heading, you've got the usual suspects, but maybe amplified. Supply chain disruptions are a big one. Could be from inflation, labor shortages, another health crisis, climate events, even things like avian flu hitting their egg supply.
Right. That's very specific to them.
Exactly. And just volatility in the costs of everything. Key ingredients like wheat, oats, eggs, but also packaging, energy, labor, that's a constant pressure.
And competition.
Fierce across every category they're in, which means they constantly have to adapt to shifting consumer tastes and behaviors. Think dietary trends, the ongoing rise of private label, e-commerce shifts, concerns about animal welfare, demand for sustainable packaging. It's a lot to track.
They also mention relying on single suppliers for some things, and the risks of IT failures or cybersecurity incidents, which we just discussed. Plus, big ERP system implementations, those can be hugely disruptive.
Absolutely. Then you have strategic risks. A key one is making sure they successfully integrate those recent acquisitions, like Perfection Pet Foods, and actually get the benefits they expect.
Integration is always tricky.
Always. Plus, just finding and completing future good deals. And, of course, the risk of losing key people, senior management.
Okay, what about financial risks? Debt is usually a factor for acquisitive companies.
It is. They acknowledge their high leverage and substantial debt could limit future options or flexibility. And they have to strictly adhere to debt covenants, like that secured net leverage ratio needing to stay below 4.25 to 1.0000.
There's tight controls there.
Very tight.
Yeah.
They also flag volatility in the derivatives they use to hedge commodity and interest rate risk. Plus, there are pension funding obligations. And one thing that's particularly candid is the risk of goodwill or intangible asset impairment.
Meaning they might have to write down the value of companies they bought.
Potentially, yeah. They specifically note that the calculated fair value of their Weetabix unit was only 5.2% above its carrying value on the books, and the cheese and dairy unit was only 5.3% above.
That sounds close.
It is close. It's mainly due to economic pressures in the UK, cost inflation. It means those assets are being watched very carefully, as a write-down would hit their reported asset value.
That's very transparent of them. And lastly, legal, regulatory, governance risks.
Yeah, a whole suite there too. Keeping up with evolving laws, anti-corruption, data privacy, AI is emerging, food safety, the potential impact of lawsuits, a potentially significant tax hit if prior spin-offs like Billring brands don't get the intended tax treatment down the line.
Oh, interesting.
But
Tax implications from past deals.
can be very complex.
Yeah.
They also mentioned potential conflicts of interest because some directors and managers overlap with Bellring and another related company, 8th Avenue Food and Provisions.
Okay.
Plus, things like anti-takeover provisions in their company rules designed to make hostile takeovers harder. And just the general risk that shareholder actions could become costly or distracting.
Yeah.
It's a really comprehensive look at the landscape.
It really is. So, wrapping this up, we've seen Post Holdings had, by their own account and by the numbers, a genuinely strong fiscal 2024. It was clearly driven by smart acquisitions and disciplined financial management. And all that rests on a very diversified business model and, it seems, pretty robust internal systems for managing both their people and their technology.
But, as we just covered, they also have a very clear-eyed, almost granular view of a wide array of significant risks, operational, market-based financial legal setup.
Right. They're not ignoring the potential headwinds.
Not at all. Which leads to, I think, a really interesting final thought for you to consider. Given Post Holdings' clear strategy of using acquisitions and managing debt quite aggressively, alongside this incredibly diverse portfolio they've built, how do you think they'll manage that balancing act going forward? How will they pursue those exciting future growth opportunities while also, needing to constantly mitigate that huge range of risks they've laid out so clearly?